Hey guys, today we're going to go over velocity banking. So what is velocity banking? Well, velocity banking is mortgage acceleration and then using that same concept to pay off all of your debt and then furthering that with creating a true retirement plan. So before I get started with this group, I really didn't have a good understanding of what mortgage acceleration was. And in fact, I didn't even really understand what an amortized mortgage was. I just knew that when I refinanced or bought a home, I had the option of a 15-year or a 30-year fixed mortgage. I really didn't know much more than that. So what the education within our group, we are part of a real estate investing and wealth development education group. Part of that education is mortgage acceleration, and then of that, velocity banking. So let me just go over first real quick what an amortized mortgage is, because like I said, when I first got started, I really didn't even have a good grasp of what that is. So for right now, let's say we have a mortgage. So mortgage payments are about, say, $1,000 a month, paying that every month. This is what an amortized schedule looks like. You have the majority of the payments that you're making towards the beginning of the 30 years or 15 years or whatever is mostly interest. You actually have $100 of that that's going towards the principal of the balance, whereas the remaining $900 is going towards interest. So at the beginning of any 30-year or 15-year mortgage, most of your payments are going towards interest and very little is actually going towards the principal of the balance. The majority of Americans refinance their mortgage every 5 to 7 years. Very few Americans actually pay off their mortgage in 30 years. It's actually less than 1%. So every time you're refinancing the mortgage every 5 to 7 years, all you're doing is really extending that mortgage out to a 35-year or 40-year mortgage because you're not paying it down very much at all. Let me actually show you what you're doing with the mortgage. This is an example of a 30-year mortgage, $300,000 at 6%. With this mortgage example, you have about $1,800 that's going towards the mortgage payment. $1,500 of that is interest, and less than $300 a month is going towards the balance of that mortgage. If you look at the end of 1 year, obviously still the payments are $1,800. After 1 year, you've paid almost $18,000 in interest, and you've only paid down the mortgage less than $4,000, and that's after 1 full year of payments. If we look at the end of 5 years when people are typically refinancing their mortgage, over the course of 5 years, you're paying about $108,000 in mortgage payments, obviously. Of that, $87,000 went towards interest, and you only paid down the mortgage a little over $20,000. If I came to you and asked you for a loan for $20,000 that I would pay back in 5 years, and at the end of that 5 years, I will have paid you back $87,000 in interest, I will have just signed up for a 413% loan with you. So every time you're refinancing that mortgage every 5 to 7 years, you're converting that 3%, 4% mortgage to a 400% mortgage or loan that you took out with the banks. That's why every time you go in and say you want to refinance, you want to get another loan, you know, they pull up a chair, they play with you some coffee, because they know every time you're refinancing, you're not taking that 3 or 4% mortgage, you're changing that to a 400% mortgage. So let me actually show you what our concept is with the mortgage acceleration. So with the mortgage acceleration, let's just say we have here a $300,000 mortgage. And let's say for this example, we have, about $4,000 a month that comes in with direct deposits and payments, whatnot. And then we take that and we, like everybody else does, we put that into a checking account. And then let's say, for example, we have $3,000 that goes out towards bills. So we have $4,000 that's coming in and $3,000 that's going out. The other $1,000 a month we're leaving to savings, retirement accounts, or something like that. What our concept is of velocity banking and mortgage acceleration is opening up a line of credit Now, a line of credit has a lot more flexibility than the loan with the amortized mortgage loan. There's no flexibility whatsoever in a loan because the payments that you make into it are there. You can't pull them back. You can't take out any other money from that mortgage or amortized mortgage because you've already set it up. There's no flexibility in it whatsoever. With a line of credit, there's a lot of flexibility. If you have good months, you can put more into it. If you have bad months, you can just put less into it. So it just kind of depends on what you are doing, what's going on with your situation. With the line of credit, you have a lot of flexibility, which is great for us as investors. So with this example, let's just say we have a $20,000 line of credit. So what the concept is taking, let's just say $10,000 and immediately applying that to the balance of the mortgage so that you cut your mortgage down immediately to $290,000. Now, the beauty of this concept, the velocity banking, is we're not adding any debt to your structure. We're not taking away from any cash flow of your monthly cash flow, and we're not asking you to make any additional payments from your cash flow. So with this concept, you still have $300,000 in debt. You have $290,000 here and $10,000 here. Now, we do have this new line of credit, but with velocity banking, all we do is we run everything through this line of credit, so you don't have this extra monthly payment with this line of credit, because all of your direct deposits that you have every month, the $4,000 and everything going into this line of credit, the banks are considering that your monthly payment. So you're satisfying that minimum monthly payment every month just by simply having all of your direct deposits and everything go through this line of credit. Now, the line of credit that I have, a home equity line of credit through Wells Fargo, it is exactly like a checking account. I have unlimited transactions that I can make. I have a checkbook. I have a debit card. It's tied to my phone app, so I can just transfer funds back and forth. There's zero difference whatsoever between my home equity line of credit and my checking account as far as functions go. So we have everything that goes into the line of credit and pay all of our bills out. So let me show you. So we have $4,000 that comes into the line of credit, and then the $3,000 that goes out that we use toward paying bills. So with that, we have $1,000 that we're leaving behind every month that is just paying down this $10,000. So we have the $10,000 that we took from this line of credit and we applied it to the mortgage. So now we have a $10,000 debt. With this example, we have $4,000 coming in, $3,000 going out. So we're leaving back every month $1,000. So that's decreasing the balance of this home equity line of credit by $1,000 every month. So let me show you the benefit of this and why we actually are suggesting this. So with that first chop of $10,000 to the mortgage, to the mortgage balance, we now are at $290,000. That actually puts us at month 31. So had we made 31 payments to the mortgage, that would have gotten our mortgage balance down to the same amount as if we just do that one chop. So simply by doing that $10,000 chop to the mortgage, we just simulated doing 31 payments to the bank. So we're now at month 31. So by doing that, we just skipped 30 payments, 30 mortgage payments. So each mortgage payment being about $15,000 in interest, we just skipped 30 payments of $1,500 in interest that we didn't have to make. So now we have the mortgage balance at $290,000 and a home equity line of credit at $10,000. Every month, we're leaving back $1,000 from our income. So we're going to pay down that $10,000 by $1,000 every month. So it's going to take us 10 months to pay this down. So once we get to 10 months, we now have a zero balance in our home equity line of credit. And let's see where that puts us. So 41 here, we are there. So we now have a mortgage balance of $286,000. So if we look, we're at $286,000. And now we have a zero balance in our home equity line of credit. Once we have more credit available in our home equity line of credit, because it's a revolving line of credit, so as it goes down, we can use money from it. As it goes up, we just pay it down. It's literally just like a credit card in that it's a revolving line of credit. So once we get our home equity line of credit down to zero, we simply do another chop. So we now have an additional $10,000 that we just write a check, principal only, to the mortgage. That puts our mortgage balance at $276,000. If we look here, that will take us all the way down to here, which is month 67. So we're now at month 67. So in the 10 months that it took us to be able to do these two chops, we just skipped 57 payments of mortgage payments. And that, with this example, just saved us $75,000 in interest just this first 10 months of doing this. We're not adding any debt. We're not changing your cash flow, or we're not asking you to pay more towards your mortgage. It's simply realigning how you pay your bills and everything, and knowing how the game is played by the banks. So there are actually two ways to speed up this process even faster. The first, remember I said we had $4,000 that's coming in from direct deposits and everything, and we had, say, $3,000 that's going out. After you're doing this for some time, you'll be able to pay down your debt, the $3,000 that's going out. You can use this line of credit to pay off your credit cards, car loan, even your mortgage eventually, so you don't have a mortgage payment. So you have the $4,000 going out, and you can get this down to, say, $500 a month, because you are going to have utilities, cell phones, stuff like that. But once you pay off your other debt, you can get this down so that you have only $500 going out. So with that, if you get that down, you're then able to have $4,000 coming in, $500 going out. You'll now have, say, $3,500 a month that you can leave behind. So once you pay off all of your debt, a year, 2, 3, 5 years, however long it takes, depending on how much debt you have, once you pay that all off, you'll be able to leave back the $3,500. So you'll be able to do a chop every 2.5 months instead of 10 months. Because with this example, we had $10,000 in the line of credit. If we're leaving back $3,500 every month, we'll be able to pay that $10,000 off in 2.5 months. Now, the second way, which we absolutely love, involves real estate investing. So by getting positive cash flow rentals, you can accelerate this even that much faster. So what do I mean by positive cash flow rentals? So when you have a mortgage on a piece of property that you have, and you have renters in that, if you have the rent that's coming in that pays the principal, interest, taxes, insurance, and management fees, when you have a rent that exceeds that amount, you have positive cash flow rentals. So say you have a property, I have a property that the mortgage and property management is $1,100. The rent that I'm getting from that property is $1,700. So with that property, I have a $600 a month positive cash flow rental. Total, all in all, I have 4 different rentals, and it's bringing in about $3,000 a month positive cash flow rentals over top of the mortgage, interest, taxes, insurance, and property management. So I have tenants in the property that are paying the interest on the mortgage that I'm paying. I get the tax benefits for the interest, and also getting the appreciation from the properties. I get to write off the depreciation factors of the mortgage as well. So a lot of benefits besides just the cash flow, but the positive cash flow rentals is a significant part of this. So like I said, I have 4 rentals that I'm getting about $3,000 a month in positive cash flow. So that, coupled with the base income that we had, so I have about $6,500 that I can leave back with that line of credit every month. So with that example, I can do a chop, that $10,000 chop, every month and a half. So with that 30-year mortgage, because I can do a chop to it every month and a half with the $300,000 mortgage, I can pay off that mortgage in 45 months. So in less than 4 years, I can actually pay off the $300,000 mortgage. So the beauty of that is once you have that mortgage paid off, you now have all of that available in equity. So I can restructure my home equity line of credit. So now I get 80% of that full value. Use that full amount to invest in more real estate properties. And when you're investing in those real estate properties, you're getting more and more positive cash flow rentals. So therefore, you're accelerating how fast you can do the chops. So the more equity you have, the more positive cash flow rentals you can get, the faster that you can accelerate this. So it's just a snowball effect where you can start paying down mortgages faster and faster and faster to the point that you get $1 million, $2 million lines of credit, and you can start buying portfolios. And when you get to that point, you start creating a true retirement plan where you can very quickly generate $100,000 in passive income, where the renters that you have in your properties are paying off your mortgage, and taxes, insurance, and everything, and property management. You have property management in place, so they're covering everything. You don't have to worry about it. And it just creates an incredible snowball effect by really developing a true retirement plan. So that is just one of the really great educations that we have within our real estate investing group. We do have more information available for other educations that we have. This was just a mortgage acceleration and velocity banking education that we have. In addition to this, we have credit repair, we have self-directed IRAs, we have all the different ways to invest in real estate acquisition, exit strategies, and everything. If you'd like more information about our group, or if you have any questions about this concept, feel free to get back in touch with the person that sent you the link to this video, and we'd be happy to talk with you. Thanks a lot for listening, and talk with you soon. Bye.